The market crash reduced American aggregate demand substantially. Consumer purchases of durable goods and business investment fell sharply after the crash. A likely explanation is that the financial crisis generated considerable uncertainty about the future income, which in turn led consumers and firms to put off purchases of durable goods. Although the loss of the wealth caused by the decline in stock prices were relatively small, the crash may also have been depressed spending by making people feel poorer. As a result of the drastic decline in consumer and the business spending, a real output of the United States, which had been declining slowly up to this point, fell rapidly in late 1929 throughout 1930. Thus, while Great Crash of the stock market and the Great Depression are two quite separate events, the decline in the stock prices was one factor contributing to decline in production and employment in the United States. Banking panics and monetary contractions. The next blow to the aggregate demand occurred in the fall of 1930, when the first of the four waves of the banking panics gripped the United States. A banking panic arises when many depositors simultaneously lose confidence in solvency of the bank and demand their bank deposits be paid to them in cash. Banks, which typically hold only a fraction of deposits as cash reserves, must liquidate loans in order to raise the required cash. This process of hasty liquidation can cause even a previously solvent bank to fail. The United States experienced a widespread banking panics in the fall of 1930, the spring of 1931, and the fall of 1931 and the fall of 1932. The final wave of the panics continued through the winter of 1933 and culminated with the National Bank holiday declared by the President Franklin D. Roosevelt on March 6, 1933. The bank holiday closed all the banks and they were permitted to reopen only after being deemed solvent by the government inspectors. This panic took a severe toll on the American banking system. By 1933, one-fifth of the banks in existence at the start of the 1930s had failed. By their nature, banking panics are largely irrational, inexplicable events, but some of the factors contributing to the problem can be explained. Economics Economic historians believe that the substantial increase in the farm debt in 1920s, together with US policies that had encouraged small, undiversified banks, created an environment in which such panics could ignite and spread. The heavy farm debt stemmed in the part of the high-priced agricultural goods during the World War I, which had spurred extensive borrowings by American farmers wishing to increase their production by investing in land and machinery. The decline in farm commodity prices following the war made it difficult for farmers to keep up with their with their loan payments. The Federal Reserve did little to try to stem the banking panics. Economics Milton Friedman and Anna J. Schwartz, in the classic study of the monetary history of the United States 1867 to 1960, argued that the death in 1928 of Benjamin Strong, who had been the governor of the Federal Reserve Bank of New York since 1940, was a significant cause of this inaction. Strong had been a forceful leader who understood the ability of the central bank to limit panics. His death left power vacuum at the Federal Reserves and allowed leaders with less sensible views to block effective intervention. The panic caused a dramatic rise in the amount of the currency people wish to hold relative to their bank deposits. This rise in currency to deposit ratio was a key reason why the money supply in the United States declined 31% between 1929 and 1933. In addition to the allowing the panics to reduce the U.S. money supply, the Federal Reserve also deliberately contracted the money supply and raised interest rates to reduce the U.S. money supply. The Federal Reserve also debated in the September 1931 when Britain was forced off gold standard and investors feared that the United States would devalue as well.